Good morning, everyone. Sound check. Sound check. My name is Josip Kasik. Today is February 5th, 2022. Please take a moment to read the disclaimer. Trading with the UFO website is not a financial advisor entity. We do not provide the financial advice. Everything we do is for educational purposes only. And I'm encouraging all of you to get in touch with me by going to the tradingwiththeufos.com and slash, where you can ask any question regarding everything that we are covering here. And thank you, Joe. Thank you, Mark, for confirming. One of the things that I want to point out to you here that you might not be aware of it, that if you scroll the page all the way down to the bottom and past these comments that I usually have, there's a tab that says books and articles. So when you click on the books and articles, there are going to be a number of books that we have suggested that are really good. And of course, when it comes to option as a strategic investment is almost like the lead in the industry. However, down here are articles, and I have written a couple of them. One is about the synthetic long, and I think, Mark, you probably remember I did a couple of the webinars on that. It gives the explanation quite in depth. And over here is the managing a Tesla that I noticed not too many people read. So what I'm going to do, I'm going to click on that, copy that link into the chat box, and then everybody can just simply click on it and read this. Because what is interesting about this trade, and I don't want to talk too much about the trade before I give a big picture, is that the trade has gone against me. And I was able to what is called salvage that trade and fix it and still be profitable. I think at the bottom I actually give an explanation how did total, and the trade has gone against me. And this is what the beauty of options with options is, that if you were in a long stock trade and it goes against you, get stopped out and you have a bitter taste in your mouth, right? Over here, it hasn't gone the way I want it, but because I was trading options, I threw another options on it, and I was able to then repair it. So if you can just confirm it that you got this in the chart, I would really appreciate it, Joe, Mark. And I really think you can benefit from reading this. So anyway, I would like to also share with you agenda for today. It took me a little bit of time to prepare. I want to make it a little bit different, so you won't hear me banging here on my keyboard and typing because I already have typed in. I'm going to go over the big picture because today is the first Saturday of the month. Thank you, Mark. Joe, I hope you got it too. And what you're going to notice is that I'm going to spend on the big picture only about 10 minutes, right? But my main focus of today's session, trading psychology is going to be whatever leftover time we have, is to look at the sectors. Because if I ask you what moves the Dow Jones Industrial, your answer should be instantly Dow 30 stocks, right? But when we get to something more complicated, what moves the Russell? Well, you can't say 2,000 stocks because those 2,000 stocks belong to different sectors, right? So Joe and Mark, you get this. Rather than you looking at the 2,000 stocks of the Russell 2000, which is, I mean, I have never done it, nor am I ever planning to do. I'm going to look at the sectors, and most importantly, I'm going to look at the main sectors that represents most of the weighting on these indices, right? So, and then I'm going to start looking at the targets, and I'll tell you my bias after I'm doing the big picture. So basically, big picture is about the overall bias at the stock market. What's your outlook? Because I know when I was a beginner there at the early 2001, somebody asked me, what's your stock market outlook? And it's kind of silly, like all that I said to make money, like, and the guy's like, well, That's not what I ask you. I ask you, what is your outlook? You know, I was like, what do you mean outlook? You know, well, are you bullish or are you bearish? And this is the year 2000. You know what happened in year 2000? Technology just fell apart. The market was in the real bear movement. And me saying, you know, I want to make money, you know, like that didn't specify, you know, are you going to make money by shorting the market, or are you going to be making money by going long on let's say VIX, you know, which is an inverse, right? So really, big picture is about the bias. So what I like to do is what I always do is bring up the place that I taught you how to create before, which is a 4 monthly. And when I bring this up, I really want to point out to you that reason why the time exists, according to Albert Einstein, is that not everything happens at once. So not everything can happen at once, right? So we need to look at these things and observe, as I like to say, O and O, objectively. No emotions or any of it. And I'll start with the Dow, because the Dow was my first candidate that I really was considering trading when I started, right? Because one of the most common measure for decades has been the Dow Jones Industrial Average. So I rewatched one of my planes and I noticed that the red line on the chart that has a black background doesn't come out good. So please confirm with me over here if the blue line looks a little bit better, so you can say like, oh, now I see it better. So again, what we are doing here is very simple. We are again considering what the price action has done in relationship to December. So in the relationship to December, January has pierced below, and it has moved up in a range. So if we know that's the case, now being the new month of February, we can do the same thing, looking where are we in the relationship just to the January. So we just started right now, February, but what are we doing in the relationship to January? And we're doing nothing. We're completely chopping here within a range of both January and December. So really, trading Dow is like a flipping a coin at this point. You know, like we concluded it's the strongest, but that doesn't mean for next week we need to trade the Dow. Good. So please give me a little chat box that you got my explanation of the Dow, so then I can jump to the weakest one, which is Russell. Thank you, Joe. So things are looking good. I'll do the same thing over here. I'm going to just change this line into blue, right? So I change this line in the blue, I change this line in the blue, and then when I click OK, it's going to show that it's a little bit more obvious. Okay, so this is a price action for a February that just started, but because I'm using monthly, and I want to make sure that I, let's say, use a yellow color now. So over here, as you can see, I'm looking at the monthly, and this particular bar is really just a last week activity, right? So I still want to then refer to what the price action has done in relationship to the December. So in relationship to December, right here, this was a December, we have broken to the downside in January. We have closed to the downside with the conviction right here. And right now we are still trading below it. So if I look at this as a high up here, and then I have here what I like to call the lower high, then obviously we also have a lower high over here on February, but that's not yet done, because really definition of the trend is to also have a lower low. So if I have this as a low, then this would be the lower low right here on so this is February, January, December, November. So it's in November that the Dow Jones already start losing its steam to go up. It's kind of interesting. In November, it was actually challenging the 10-month high, but it poked the head above and then it completely fell apart. So it created also lower low in a January. And of course, I can't write the lower low right now because this bar is not closed. So Joe and Mark, if you got this, then you'll understand that there's a huge difference between what the Russell is doing versus what the Dow is doing. Dow is back in the range; it's holding its ground. I mentioned this once before, and I don't know if I'm offending anybody, but you should look at this as a borderline between the two countries. And if the redcoats have stepped into the whatever that other country is, then that's mean that country is being invaded. However, you cannot say that to the strongest one, which is the Dow Jones, because what happened with the Dow Jones, we simply with the Dow Jones have moved within the range. So obviously the Russell is the weakest, but then what are we going to do? Look at all 2,000 stocks to pick what we're going to do? No, this is what I was thinking to share with you that you can do. You can look at the sectors, and the way how you look at the sectors, and I'll just go over here on a Google. You type in sector weighting of the S&P, and then you click the visual, right? So over here, when I go back, sector weighting, you have a word for images. So when you click the images, it's going to show up over here, and you will know that the once a month, what they actually do is change the weighting of that. So what I'm going to do right now, I'm going to take a snapshot of this, just to put it in a Word document, so I can actually type some notes below it, and I can scrutinize this, as I would like to say, in a little bit more detail. So I'm still talking here about the sectors and targets, or I'm just getting into it because I just finished my overall bias. So I concluded that basically Dow is the strongest, IWM is weakest. I'm going to come back a little bit later on technology because I do want to talk about the technology right now, because the way how this pie works, this particular chart, and let me see if I can just arrange the font in such a way that you can see everything. Okay, so this pie right here, about the one-fourth of the S&P 500 is the technology. So should it be then important for us to know what is a sector called XLK doing? XLK is a sector for technology, right? I think it would. So what I want to do right now, I want to just quickly go back to the NASDAQ and observe how's the NASDAQ doing. So QQQ is an approximation for the, I'll just take a sip of water for a second, for a technology, for a NASDAQ, right? NASDAQ has an A word, which means automated system, right? So what is happening over here with the NASDAQ right now, let me just get rid of this because I don't need it and I don't need it. So as I'm getting rid of this, I'm going to be able again to approach it in the same way and point out to you that we have lost with the conviction December low. And it's a big deal because we haven't been able to reclaim it. In fact, what really happened, we closed lower. Even when we rallied, we didn't even approach the range of the December. So you can make an argument, well, right now we're stuck in a January range. Yes, we are. But now let's compare this against the sectors. So what I'm going to do right now, I'm going to teach you the way how you can create a new space. So you just create a new chart. You type in XLK, right? So when you type in XLK, you have a XLK. But notice what happened with and let's use a blue one, with the time frame. The time frame that has been selected to me instantly was daily. Well, if I'm going to be using the same kind of approach, I should be changing this to which time frame? Well, obviously the monthly. So I'm going to go on the monthly, and I'm going to have a sense of deja vu that I have seen this before. But notice over here, it's interesting that we, since the 2009, have been in such a strong move to the upside. These red months over here that you're seeing was really just a blip on the chart, because when we crash here in the year 2000, right, that was just blip on the chart, because really what ended up happening, we ended up taking out this and going where? Straight up. So when you're looking over here and you're observing that we have gone straight up on a technology, it's kind of unhealthy for us to expect that we're going to go higher and higher and higher without ever coming right back down, right? So what I'm planning to do right now, I'm planning now to zoom this in so big so we would have a less data to look at and more comprehension, that we want an alignment. And what I mean by the alignment is I want all the markets to go in the same direction in order for me to be bullish. And in order for me to be bullish, technology would also need to go up. So in order for technology to go up, technology would need to cross this, what I like to call, line in the sand. And as you're looking right here, technology did attempt quite hard to get back above. In fact, I would say about the half of the move down has been reclaimed because we have came here to some kind of support. Right now, we are still trading below, but there's a lot of days in this month, so we could maybe go up. We could go up. But that's just the one thing that I want to point out to you. That's just the one thing that I want to point out to you. The other thing that I want to point out to you, and I'm going to go back to that Google page. Actually, I can just go to the Word document because I already planted that thing inside my Word document. So you're looking here, the largest percentage, by the way, they do change, like at the end of the month by maybe like a 0.5% or 1%, sometimes 2%. The next one biggest slice of the pie is financial. And if you add these two numbers, think about it, that's close to 40% of the movement of the S&P. So then we would need to also look at it. What is the financial doing? Next one is a healthcare, and the next one is discretionary. So I'm gonna just provide you the tickers for it. So XLK is tech, right? Then we have a financials, and conveniently financial starts with F, right? And that ticker is XLF. Then we have a healthcare, and that's actually ticker is XLV, and the last one is the cyclicals, which is XLY. Okay, so what I'm gonna do now, just to kind of save a little bit of time, I'm gonna cheat over here. I'm gonna open this page of the, no, I don't want this, of the daily, because I have created before the daily for these four majors, right? And all that I'm going to do is I'm going to type on the top XLK for a technology. I don't know why is this not accepting XLK technology, XLF for my financials. Down here I'm going to put the healthcare sector, and over here I'm going to also put my cyclicals. And now when I go over here, file, save page as, I'm going to call this 4 sectors. I can call 4 main sectors, but you get the point. 4 main sectors. And if I can revisit one more time that Word document that I created, and just kind of point out to you here, when you look at this with the consumer discretionary and a healthcare, which is, I don't know, let's say another 30%, which is not really 30%, 25%, 25% on the top of this 40%. We are talking about these 4 sectors. These 4 sectors, okay, 4 sectors. I will talk about the trading psychology at the end. 4 sectors give me the weighting of about 60% of the S&P 500, of S&P 500, right? So I think just looking at these four charts, you would anticipate that their movement on a daily basis is going to indicate whether or not you have a bullish bias or a bearish bias. If this is good, please type it in. I got it. I understand. This is good. So Joe, Mark, Howard, please type it in. Okay, so let's now go back and look at a daily on XLK for a Friday. We attempted to go higher, but what is interesting, when we attempted to go higher, we got beaten down at the day's end. At the day's end, there was a sell-off. Okay, but still the bar is green, so that's very significant. When I look at the XLF, let me just enlarge this and change it to XLF. I'll later on deal with this. XLF, very interestingly, on a daily, again, I'm going to emphasize that this is daily, right here, you can see it, has taken out the high of that move down that we had on Thursday and has closed above. So you're like, wow, I'm really surprised. Well, don't be surprised. The whole reason of us doing this is so we can find the targets, and my target is bullish on XLF. And XLK, SOH, sit on your hands with the technology. Why would I sit on my hands for a technology? Because is the chart of technology quite different than a chart of the financials? So look, if I just have a line in the sand, okay, I want to go home up north. And what happened? Well, what really happened? Nothing. Unable to go up through the high technology is. So technology yesterday was unable to take out the high of Thursday. Hitting escape, going back to the financials, pointing out to your financials, quite different situation. High of the Thursday, even with the slight little sell-off that we had, it's a candidate. Why would be that the case? Well, the Feds have already talked about this. They're going to be raising the interest rates. And if they're going to be raising the interest rate, who's going to benefit from that? Well, obviously the banks. So what I can do later on, once when I'm done looking at the healthcare and also cyclicals, is that I can consider the strongest of the three and then start selecting one of the trades before I go into teaching a little bit psychology. Okay, let's go type in XLV. Just get rid of the other stuff. And look at the situation on XLV. If we are now just considering this strictly from the technical point of view, we have gone down, we have bottomed out here. On this big, huge bar, we took out this high, which is very significant. And from then on, it was appearing, after we crossed that border, we're off to the races. That we are going where? That we are going higher. Then that little bar right here that was a Thursday was obliterated on Friday because we traded above, but then we failed where? Below. As of now, the bar is still green, but overall, I can draw the trend line from the bottom to here and to here, but because this will not stay, we will probably just use the tools that we actually have here on the platform, because when we use these tools on the platform, they do stay permanently rather than me using this bit. So this would be what I like to call the primary trend, and this would be secondary trend. Still, comparing this against the financials, I think the financials are quite stronger. So I still prefer the financial. So out of the three, I would put the technology on the bottom, the one that we just look at the health in the middle, and a financial on the top. So I'll give the targets for both, for the healthcare and for financial, but I do want to look at the cyclicals. And just before I look at the cyclicals, I'm going to share with you the website that is called FinViz. And when you go on a FinViz page and type in Excel, and you can just stop. You don't need to type anything else. You can just stop. All the sectors are listed here, as long as you don't type in the third one, right? So B stands for basic materials, C stands for communication, E stands for energy, and then there's our F that we looked at. Then you have an I for industrial, then you have a K, and I don't know why I didn't put the Y. I mean, like, they're supposed to put the Y in it. Oh, maybe it was on the bottom of the list, but I didn't scroll it. And there's your consumer discretionary. And as you know, in the United States, like the spending of the government on consumers represents the big chunk of economy, right? So having said that, let me just now go back over here and look at XLY and look at it, how it's looking. Well, obviously, in relationship to the price on Thursday, we have closed higher, which is good. But still, what is there that is bothering us? We still have a Wednesday high that we need to take out. So what I would like to do now in my notes, I would just like to share it with you that out of the four sectors that represent the S&P 500, right? XLF is the strongest because of Feds talking about increasing the interest rates, right? The XLF, these are the health stocks, that's connected with the vaccine and all this, is the second, I would say, strongest. Okay, so let's use now top. Top is ready to provide us with the target. And yeah, okay, that's fine. And I'm gonna just open options with options here. And when it opens option with option, I'm gonna look at the XLF. And I'm gonna go on the daily here. So we're looking here in terms of the current versus standard deviation. We're looking good. Calls are better than puts. That's good. Over here we can even use Tom's speed map and project it up there. But where can I find the target over here? If I go just for the previous high, over here at the 69.87, let's say 69, let's go 70, okay, approximately 70, let's go send to 69.71. That's not really exactly where I wanted to click. I wanted to click here about 70. I want to see what kind of trades are gonna get populated here. So I'm gonna just hide this risk bar for a second, and I'm gonna scroll over here to see the risk to reward. Okay, risk to reward over here, it's looking best for a bull put spread. And now these bull put spreads that are gonna be expiring, and I'm looking right here on this area, which would be the February 13. I would probably use the regular monthly options for that. And instead of using the bull call spread, right, which has not such a good rate of return, I'm going to be using the bull put spread. And these bull put spreads that I'm looking involves the strike prices 66, 69, 68, 63, and the 68, 65. So between the 68, 65, which is the $3. This is the one I'm looking. This is the one that I'm looking. And a profit of the 105 versus, and let me just change this color to green, this one that is a slightly lower strike price, 63.68, it's a better one. So what I'm going to do right now, I'm going to memorize the buying of the 63 put and selling of the 68 put. And let's now quickly build this and prepare it. So if the market continues going higher, it's supposed to work out pretty good. So XLF target is above 69 or 70. So if it's above the 69 or the 70, then selling to open 68 put makes perfect sense, because if we go ahead and expire above it, right? 68 put, if we are at the 69, would be then completely worthless. And by then, maybe they're going to increase the interest rates. Maybe they won't. Well, they won't, because every 6 weeks they meet, and the next meeting is actually in March. But they indicated the possibility of maybe raising the interest rates even 5 times. And then a lower one would be buying to open, and it was a 63 put, which gives us then $5 investment, right? And out of that, we got the credit, and I think that credit was about $1.50. Okay, so let's now, and this is done on February regular monthly expiry. Okay, so we're just kind of preparing this trade. So what we're gonna do next now, we're gonna pull up the chain. When I pull up the chain over here, I'm gonna select February 18, get rid of the March 18, which is another monthly. Next, what I'm gonna do over here where it says strikes, I'm gonna ask for more strike prices, and I'm gonna then scroll it all the way over here to the put side, or I can just go very simply, instead of the doing this, I can just alter it right here on the bull put spread when I go under the edit. I personally prefer to do that way, because it populates the puts, it populates the buying of the units, selling of the units. The only thing that I need to alter is really strike prices. So when I alter over here to 63, and I alter this one to 68, and I agree, and I know market is right now closed, I get here negative sign. Let me take a snapshot of this. This might really help, because I kind of start playing with this, and I think it really helps visually quite a bit to understand what's going on. So if I now snapshot this and put it inside this Word document, so this is what I was toying with. I actually have a 63 is bought, right? 68 is sold. So sold, 68, bought, 63. Right now, these are the prices, but be aware of it, what's happening at the weekend. They widen it. So when they widen it over here, then this is what's going on. So this is a credit of the $1.16. And then if we really want to know how much are we risking, and I'll just keep this simple so there's no mistake here. So you just take here $5 and you subtract from it $1.16. You get the outlay of the capital that you need to have, $384, right? So when you're looking at this, you're putting less than $400 into this trade, and you might end up making dollars if this goes all the way to the expiration. Okay, so my cost of this trade, or a maximum loss, is $3.84, right? So you can trade this one lot and see how it works out. So let's now entertain the possibility of the XLF trade, XLV trade, which would be a healthcare. So XLV trade, and let's see if I can just bring back again FinViz there for a second. So XLV, right? So you get a little information here. It's a healthcare, right? It still has a potential to go up, maybe even all the way to the 136. But let's look at platform. Where are the UFOs? Because the problem that I had with XLF, I didn't even have the UFOs about it. In this case, I do have a UFOs about it. So overall, the trend would be up. The trend would be up over here. Over here, if I would just take a tool and draw from the top to the bottom, you would see that this down trend has been broken to the upside. Now we're pausing in this area, but overall, there is a possibility that we might go higher. And then, of course, the question becomes where. Well, this is the first set of UFO, and this is the second set of UFOs. So I'm more inclined to look at this area around the 136 than anything else. So if I place the mouse right here, single right click, send to, ask the Trade Active Option Planner to spill out the examples. A rate of return is looking really, really, really good over here. Let me just hide risk graph, scroll it over here to see the outlay of the capital. So of course, bull call, we need to always pay for it. I personally prefer to get paid first, right? So I'm more like a bias on the bull put side. Now there's one thing that I didn't look at yet, and what is going on over here. Well, you see, in this case, because the calls are cheaper, it's okay actually to do the bull call. It's okay to do the bull call. So one more time, I'm picking the same area, which is around 136. I'm open-minded to pay for my bull call. I can talk about the financing a little bit later, right? So I'm looking here. They would be giving me then higher percentages than what the bull puts are giving me, because the bull puts are good, but they're really not as juicy in the premium as the calls. And why would be that? Because the calls are cheaper, and if you move higher, then that's good. So the market maker knows something, and obviously they know the same thing we do about the interest rate. I'm going to be entertaining between these three. Over here, it's telling me how much it cost. This cost 140. This cost 213. Let me just now zoom in over here, and I'll try to utilize this in such a way that I'll come back and get the front part of it. So what I'm doing right now, just kind of teaching you how you can help your eyes to go through this selection for XLV. So we're now working on a sector that is a healthcare. I'm going to insert, I'm going to have two boxes. And now I'm going to put in this box just the information about the outlay of the capital. So over here, it's like, well, over here, you're outlaying more capital, but you don't know the width of the spread, right? So I would need to now go back over here and capture the exact information that I have for these top three and have them side by side. So we already know the name of the strategy. The name of the strategy is called bull put spread. We already know the expiration. But what I need to know over here is also this information right here that I always talk about. And I recognize the name Mark and Joe. You've been with me in a previous session, and you know how it's actually so crucial to look at the open interest and also to look at the volume. So when I now get this out, I got my information about the volume, always the smaller numbers of the volume, and over here the higher numbers are the open interest. So really, I mean, out of That, and is it okay if I call it dictionary? Because dictionary is this thick book that has a lot of information. I just need the 3 words. I need the words about this $3 spread and this $3 spread. And notice over here, 7 minus 2 is a $5 spread. But I was able to pick that up, that it's not like these other ones. Because if these other ones cost me 140 and 184, this one is poking my eyes as if it's something different. So now that I know that what the difference is that this one, when you subtract the 7 from 2, you get 5. Over here you get what? 4. Over here you get the 3. So now you know that this is a this one right here is a $3 spread. Let's see if I can type it. No, it doesn't work that way, but I can cheat. I can go add one more column here. So if I add one more column to the right, okay, so this one would be $3 spread. This down here would be the $4 spread. Come on now. This would be the $4 spread, and this down here would be the $5 spread. I don't have a proper comparison of the side by side, right? So you're like, well, okay, but then how does that thing work? Well, how about this? Okay, rate of return. It was right there for us to see that the rate of return is what makes the difference. Okay, so I can make on this one 74.9, 74.5, and 71.3. Obviously, in my opinion, the one that is the best is the one with the highest percentage. So it's okay if I don't get all 74, if I, let's say, hit the target and I take it off at the less, right? But I want to again explain, and if I need to re-explain, I'm going to re-explain that everything goes back to the chart. Everything goes back to the chart. So currently we are sitting at the 132.30. That's what we need to keep in mind. So if you're sitting at the 132.30 and we're building this piece by piece. So I'm going to now right here. And we are now considering, and these are the targets, right? So I'm going to have a target on the bull call is above. So in this case, we know that's a 135, right? So if I do it right now, that 135 call would be what I like to call out of the money. So, and what am I doing with this out of the call? I'm selling to open that 135 call that is currently out of the money as the target, okay, and it's above. I'm going to color this in yellow because this is my current price. Now notice over here, when I look at what am I buying, I'm really buying at the money. Well, you can make an argument for $5 spread, you're buying at the money too, and then you're placing your target all the way up to 137. Well, that's why I'm revisiting these things, because the computer just spit out the highest rate of return, but it's us trader that need to choose which one you want. So let's say, just complete change of topic. You entered a car dealership and you know you want to buy Tesla car. And then a question comes up, which color? And you're like, well, dear, what do you think? I never thought about the color. Okay, so now you're looking at your spouse because your spouse selects the color. In this case, you need to look at this. Am I buying the 132 that is at the money? Am I buying the 133 that is out of the money? And why do we say it's out of the money? Because if we are currently sitting at the price that is 132.30, then that would be still 70 cents out of the money, right? So in the two situations, we have the at the money 132 call, okay? So if I'm now looking side by side, I can have a target on my $5 spread at selling to open 137 call. So let me now make this even simpler, because I don't want to overcomplicate this. I want you to understand, if you're doing this alone, there is a difference between you selecting the target at the 137 and you selecting the target at the 135. Although the same unit is being used here. See, so now there's no variation between this unit on the bottom. You both had the same units on the bottom. That's not even an issue. The issue is the target. Well, how do you decide? Well, the way how you decide, you go and visit the chart. So you go and visit the chart. Could we go all the way out and fill all of these things and then stop? Versus my 135, which we would call the what in the relationship, proximal or a distal? Well, it will be proximal because it's closer to rather than the one above, right? So that's all that the top trade active option planner decided to do for this particular place. It has selected the line that is on red UFOs, right? Proximal, and on this one is distal. Okay, that's all that it is. For me, it's safer to pick 137, but then at the same time, I'm quite aware of the fact that for 137, is my outlay of the capital going to be higher? Yes, it's going to be $213, right? But when this thing goes up, then you won't be kicking yourself like, oh, you need to exit at the 138, because really, you know, when this thing goes inside of these unfilled orders, most of the time it just goes through it. Because this bar, when I was learning this, it's called a speed bar. There's other words to use it, but what the really speed bar mean, it's almost like acting like an emotional selling. There's nothing resisting it when we go up. There's very little resisting it when it goes up. So take a look at over here in this area. I don't know if you visually can see this. Let me just use the other tool that I can get rid of later. Okay, this is imperfect line. But boy, when we took out this high, this bar right here, there was absolutely nothing resisting it. And it continued for two more bars. It's a similar situation with this bar right here. That when we come back in that area, there's a high chance we're not going to stop exactly at 135 because this number is here, 135. So I feel comfortable selecting 137. So Mark, is this good? Joe, is this good? Or hey, is this good? Howard, feel free to type it in because I'm planning now to move on and to build this using the 137 and 132. So I'm going to the chain. I'm going to pick I'm on a correct ticker, which is a financial. I'm on a correct ticker, which is financial. I'm selecting the bull call spread, and I'm going to edit, and I'm picking the February. I'm changing the target because randomly they select for me the dollar wide, and I'm going to pick the 137. It's a call. It's a call. I agree with it. And then it spits out over here that it might cost me $1.72. So let me just print screen, snap over here the strategy, and then I can insert this in the Word document. And Jose and I are working on actually having this thing done in such a way that if I put it in the notes, you would have it. But as of now, it's in works. Okay, I will work on a trader psychology, I promise. You know, I only designated about 10 minutes for it, right? So there you go. Okay, so what we are doing here. Oh, did I type in the wrong ticker? Thanks, Mark. Let me just see. No, right now I'm doing the Xlv technology. No, I think I'm good, right? Because the price is at 132, so I think I'm good. So Mark, I'm not sure. I'm not sure what you're referring to. Maybe on a previous example, but let me just finish this one up before I go into technology. So this is obviously the healthcare that I'm working on, right? So healthcare is right now at 132.30. I'm considering buying out the money that is only 30 cents valued, but they want $1.95. If I select the 137, look how much do I get credit? Only 23. But you see, the bad thing with the bull call spread, it must move, and it must move prior to the February 18th, right? Prior to the February 18th. So, which trade is better? Well, I don't know. I mean, let's see how the market opens tomorrow and take it from there. So, oh, the first trade, I got it. I'm sorry about that. I stand corrected. So let me now just finish up here with a little bit of talk about the trading psychology. What do you mean by the trading psychology? Well, what I mean by the trading psychology is really a mindset. And this mindset, you know what? Let me not go into trading psychology. Let me just make sure that I alter this on the March 18th. Because the discussion of the trading psychology can actually wait. So we're picking the gain 137. We're asking the top to spit out for us the target. That's right. This is going to significantly change. This is definitely going to significantly change everything. So what we're going to do now to fix this error, we're going to go again. This is right now healthcare. We're going to the bull call. We're editing it and switching it to the March 18, which is a regular. 132, 137. We are agreeing with it, and the price is supposed to be higher. Yeah, there it is. There it is. Good eyes, Mark. Good eyes. And I'm going to also include the open interest and the volume in it, just to kind of a little bit evaluate that. Okay. Before I post these notes, I'm going to clear this up a little bit, and make it a little bit more neat. So I want to just take a moment here and look at the volume and open interest. So on a 132 for a March, you only have a 14 contracts traded. That's all that you have. When I was learning this from a guys in Chicago, they usually told me 200. I was always looking at open interest and trying to justify, well, there's a 200 here. Their answer was open interest needs to be at least in the 4 digits. So 4 digits would be right here. So there's no doubt that my target is actually correctly selected. Although on that particular Friday, right, when we got the data, which was yesterday, there wasn't a much on the volume side. Okay, so could it be that we can alter this and go a little bit lower? Yeah, sure. Why do we do this? I'm going to alter this by editing the spread and just going a little bit lower. So lower than that would be 30. And I would expect on the 130 to have a better liquidity. Well, it's still in the 3 digits. It's still in the 3 digits. Now, this is really interesting situation here, because although it's in the 3 digits, I believe that when you add this 33 of the volume on the top of this 982, and that's going to be on Monday morning, we can definitely then have a 4 digits. And in that case, it would qualify. So what I'm doing right now over here, I'm going to get rid of the trading psychology right now. We don't have time to do this. Changing the 132 call with the long 130 call, and then I'm going to be selling the 137 call. Okay, so let me spit it out over here so you see what is going on. So what is really going on here is that I have altered the strike prices, but by altering the strike price, I also altered the cost of the trade. So this is now $700 in the trade, and it's about the half that it costs. So this would be 1-to-1 trade, right? I can make a 350, but when I subtract the 350 from a 7, I have a same amount of risk in a trade, right? So when you're looking over here, you're realizing over here you're investing 7, your layout of the capital is 350, but what is being supported when you add these two numbers, you're going to get over 1,000 contracts. Now, what about if the Monday morning comes up and this 33 got subtracted from it, right? Well, that's that fine thing that you won't know for sure. But I don't think that this time that you're spending with me is a waste at all. Because although I said I'm not going to do the trading psychology, could I just give you 2 bullet points and then I'm going to answer any of the questions that you have? When I was learning this from the guys in Chicago, they actually made such a big distinction between the two words: prediction versus participation. Market makers are participating in this whole thing. While I'm coming from the technical analysis field, here's my John Murphy technical analysis book with head and shoulder and inverse this and triangle and this, and I'm trying to do what? Prediction. I'm trying to do prediction. And you know what they're doing? They're making money because they're what? Participating in the market. So one more time, Mark, Joe, or hey, do you see the huge difference that did to me in terms of the trading psychology? Those guys on the floor, they had no time to look at the chart because they have the sticker tape running around the floor showing them where the price is. And all that they have on the little card, it's a number. What was the high of the previous day? What was the low of the previous day? And if the high is taken, that's their bias. And I'm like, but what about the next level of the resistance? What about if it takes down the next? They're not looking at the charts. They're participating. So we will be able to participate in this trade when the market opens and we know that the volume is going to be 0 and this number goes to 4 digits. If this number goes to 4 digits, and this number, even if you subtract the 42 out of it, it's still 4 digits. This is a pretty good spread. It's a 1-to-1 trade in terms of what? I'm investing the same amount of money that I can possibly make, but we didn't even discuss yet where the stop would be. And the best way to discuss what the stop would be to actually look at this and to say what is the low of this particular bar. So if we take out the low of the 131.33, right? Everybody sees where I'm getting this 131.33. I'm getting that out of this area right here. Is my 130 still gonna have some value? Yeah, because out of all these units that I'm having, the unit that has the most value is not the one that I'm selling at the top, is the unit that I'm actually having where? On the bottom. So I can then say in this particular case, if I have selected the 130, right? So let me just kind of participation. I'm going to type in here in a participation. So we know we are at the 132.30 on, I'll actually cut this and put it in Xlf. Xlf, right? So this is where we are. And my stop is below Friday's low that happened to be 130. And let's make it 131. Doesn't matter the 33. And I'm long, which means I bought to open or plus. That's what I noticed the market makers do. They just write 130. If I get stopped out at wherever I put the stop at 131, that means this thing has gone against me $1.30. I'm still gonna have an in the moneyness of $1 in it. Okay? Now you can say, well, you made money on your top part because your target, right? Your target or sell to open or a minus with that 137. Yeah, but this call was originally out of the money. It decreased whatever the X amount when we dropped from $1, when we dropped from a 130 to 30 down to 131, we dropped $1 30, you would need to look at the delta. If this delta was, let's say, 25 cents for a first dollar move, we make 25 cents. For that, let's say, 50 cents move, we make 75 cents. That did not upset much of what I lost over here. But still, I'm not losing the whole 350 of my investment. I'm still not losing all 350 of my investments. So if this is making sense, please look up these notes. Session is going to be over here in a few minutes. I'm going to clear this thing up. And as I say, we are working on kind of being able to provide you these kind of things in the future there under the notes. So if you have any final question, this is time to type it in a box. I want to thank you once again for attending this on Saturday morning. And I look forward seeing you not the next week, but the following week when I do the session. So all the best. Bye.